Well, I think globally, I mean, you know, the Fed is the sort of global central banker of the world, if you like, and everything starts and ends with the Fed, and everyone else follows, as we're seeing with the ECB and the like. So, you know, this is a world that is more indebted than it was in the last, before the GFC in 2007. There's no productivity growth. Asset prices are very elevated. A lot of debt that corporates have built up has gone to share buybacks. The number of zombie companies has doubled since 2007. I think this is undoubtedly the lowest quality economic recovery we've seen globally, full stop.
Which is why inflation's so hard to hit, potentially. I mean, it's a bit like Japan, isn't it? You talk about zombie companies that still exist because they're fueled by cheap money. What about zombie consumers as well? Are we all sort of basically fueled by all this stimulus and we don't function as we would have in the past?
If you look at the UK economic recovery, as an example, about 30 or 40% of it is purely related to the fall in the household savings rates, which is another way of talking about more borrowing, more debt, to fuel more consumption. So, no, I think the economic model is deeply flawed, and the system in the West is deeply flawed, particularly in the English-speaking part of the Western world, and it needs to change.
Undoubtedly, I think Mr. Gross is right. You're right. You're right. It's there, but is that a clear and present danger for the markets or for any of us as well? The debt build-up is terrifying, terrifying. And I see normal people, sensible people, anecdotally at home, gearing themselves up to borrow money to buy stuff which they'll never own on personal, you know, the rentier model, so to speak, as well, where they're renting properties, where they're renting cars, where they're renting phones. Where nobody owns anything anymore, and yet they're gearing themselves up at 7 to 10% to buy this stuff, but they'll never own the product at the end of it. It terrifies me.
Yeah, and that's a great example, and in fact you can see a lot of it. The whole system is in large part financialized, and so there's a few winners at the top, and of course you can see all this also in the structure of the tax system. So the very few pay a lot of tax, but their gains in large part depend on the continued financialization of the system. So the whole, you know, there's an element of pack of cards.
So my question was, is it a clear and present danger for the markets?
Well, it's a clear and present danger, you know. Whether you call it a bubble or an imperfect system, whatever you want to call it, doesn't really matter. But these sort of things always unwind when you tighten money. The problem is judging what is tight, and that is the sort of million-dollar question. It's clearly not as high as it was in '07. It's considerably lower, but judging the level is very difficult.
Where it would theoretically crop up would be in top-line growth, surely, because you've got a lot of companies now sort of moving towards a services style of model, and even Apple, we talk about it, you know, being a company that sold hardware products. It now has a huge services component built into the company revenue. So you've got to say, down the track, if you see a tightening of conditions and cash-strapped consumers or corporates, does it come out of these companies that have now services revenue built into their model?
Well, consumers in bad times cut the things they can cut easiest, and I suppose a lot of those services are 1 month cuts. You can cut them straight away, so there'll be some impact. I mean, Apple has so much cash, it can weather all sorts of things. So, but yeah, I mean, it's these, you know, these sort of things are clearly at risk.
How do you play the European story then? Because Mario Draghi has yesterday effectively set a very clear pathway that he starts talking in great detail, probably around September. We haven't actually got an official date, but that's the time frame about how he starts to exit from ultra-monetary stimulus. So what do you do as an investor if you know this is coming and you can effectively almost pencil into your diary?
Well, what we've been doing is shifting allocations to the US equity market out of the European equity market for the last few months because you know, Europe, I don't think, can cope with much tightening. There's very little credit impulse in the Eurozone. So,
which is in contrast to what a lot of other investors are doing that are marching into European stocks right now.
Yes, that's right. Well, I mean, obviously, once the consensus is built, it generally pays to lean against it. You know, Europe's been a great reflation trade from the lows last year as China reflated and the US backed off its hikes. Then globally, we reflated, and Europe was a big beneficiary of that. But I think that trade's played out. Chinese growth is topping. Chinese reflation is topping. And I think we'll see that in Europe as well. So I would shift money into other parts of the developed world which are more defensive, which would be things like the US.